Chapter 5, Types of Insurers and Marketing Systems. This chapter is easier. Okay. In this chapter, we will learn different types of insurance companies in the market and their marketing systems. So you will also know how to purchase an insurance policy from different channels. First section, Types of Private Insurers. In this section, we will learn different types of private insurers in the insurance market. The first one, stock insurers. A stock insurance company is owned by stockholders. If we check the balance sheet of a stock insurance company, well, it's just like the balance sheet of a general company. We can see the assets, liabilities, and equity. And stockholders own stocks, and stockholders own this equity. The objective of a stock insurance company is to maximize the stockholders' value. So their goal is to increase the value of the stock by earning profits and paying dividends. Stockholders also enjoy several rights. For example, stockholders can elect board of directors. This slide shows you the organization of a stock company. We can see here shareholders can elect board of directors, and board of directors decides who can be the CEO. Stockholders can also make important corporate decisions, such as mergers and acquisitions. Do you remember the Amazon Whole Foods merger in 2017? Actually, before the merger, the stockholders of these two companies vote to approve this deal. So if the stockholders don't agree, well, Whole Foods cannot accept the Amazon's deal. So the stockholders can make the ultimate decisions. Go back to our lecture notes. Stockholders enjoy several benefits, but at the same time, stockholders also bear all losses. In Finance 3310, we said that stockholders have the residual rights. What does it mean? It means if this company has a positive earning, stockholders are the last persons who enjoy these earnings. Who enjoy the earnings before stockholders, bondholders, and preferred stockholders, right? We can review an income statement. Okay, we can see here, if this company has a positive earnings, this company needs to pay the related expenses first and need to repay the interest payment or the principal first, the interest expenses first. After that, if this company still have a positive net income, this company can issue the dividend to the stockholders. And if this company has negative earnings, well, stockholders get nothing. Okay, so stockholders bear all losses. Go back to our lecture note. Next characteristics. Stock insurance companies cannot issue accessible policies. What does an accessible policy mean? if you purchase an accessible policy, it means the premiums you need to pay are uncertain and the protection is uncertain. For example, if the insurance company thinks now the risk is too high, the insurance company doesn't want to take this risk, this insurance company can return the insurance policy back to the policyholder, even though this insurance company already issued the insurance policy. Or the insurance company thinks now the risk increases, the original premiums cannot cover the future benefits. The insurance company can ask the customers to pay extra insurance premiums. For example, when a customer purchased his insurance policy 2 years ago, he only needed to pay $1,000 per year. However, after 2 years, this insurance company thinks that they mispriced these insurance products. The insurance premium should be $1,500 per year. So this insurance company notified this customer. And since it's an accessible policy, this customer needs to pay $1,500 next year and for the following years. So an accessible policy means an insurance policy in which an insurer can return back to the policyholder and make the policyholder liable to pay the additional funds required to cover losses that fall beyond the reserves of the insurance company. Stock insurance companies cannot issue accessible policies. Okay, so you don't need to worry about it if you purchase insurance policies from a stock insurance company. Nowadays, many big insurance companies are stock insurance companies, such as Prudential, MetLife, and Allstate. Another type of insurance company is mutual insurance company. A stock insurance company is owned by stockholders. In contrast, a mutual insurance company is owned by policyholders. If you check a mutual insurance company's balance sheet, you still can see the asset size. Okay. A mutual insurance company still invests insurance premiums into bonds or stocks. However, for the right-hand side, you can only see liabilities. No equity exists, okay, because no stockholders. This mutual insurance company is owned by policyholders. And liabilities include insurance policies and debts. A mutual insurance company still can issue debts if this company needs money. Since a mutual insurance company is owned by policyholders, who can elect the board of directors? Policyholders can elect board of directors. And if this mutual insurance company has positive earnings, has positive net income, the policyholders may receive dividends, just like stockholders, or they only need to pay lower insurance premiums in the following years. Okay, we call it rate reductions. There are two types of mutual insurers in the insurance market: assessment mutual and advanced premium mutual insurer. When you see this word assessment, well, you probably know that this mutual insurance company, assessment mutual company, can issue assessable policies. In other words, an assessment mutual has the right to assess policyholders an additional amount if the insurer's financial operations are unfavorable. If an assessable mutual thinks they misprice the insurance products, the policyholders are undercharged. In later years, this mutual insurance company can ask the policyholders to pay extra insurance premiums. Of course, most customers don't like these types of policies. They don't like accessible policies. Customers hope that the premiums are fixed and clear. So fewer and fewer assessment mutuals exist in the insurance market. Now, most mutual insurers are advanced premium mutual insurers. In other words, they don't issue accessible policies. The policies these advanced premium mutual insurers sell are the same as the policies sold by stock insurance companies. Usually, if an insurance company's name contains mutual, it's a mutual insurance company, such as Liberty Mutual and Northwestern Mutual. Recently, more and more mutual insurance companies decide to convert into stock insurance companies. This slide shows you the number of mutual life insurance companies in the US from 2000 to 2018. We can see here the number of mutual insurance companies decrease. We can find a similar trend in property and casualty insurance industry. We call the converting process demutualization. So demutualization means a mutual insurance company converts its ownership structure, originally owned by its policyholders, into a stock-based structure. Now, this company is owned by shareholders. Why do these mutual insurance companies want to convert into stock insurance companies? The first reason is easier to raise new capital. For stock insurance companies, if they need money, they can issue stocks and they can get money quickly. In contrast, mutual insurers cannot issue equity. If mutual insurers need money, they need to ask their policyholders for extra money because policyholders own these mutual insurance companies. Of course, mutual insurers can also issue debt, issue bonds, but we know that if companies don't pay the interest payment and the principals on time, this company will go bankrupt. Overall, issuing equity is a safer